Trump's tariffs are a strong real-world example that highlights several key areas of microeconomics, such as the market structures and government intervention. Tariffs are a tool governments use to influence markets, particularly by restricting imports. Trump imposed tariffs on countries like China to protect domestic industries. This is a clear example of the government stepping in to alter the free market outcome.
Shifts in supply and demand, price changes. When tariffs were imposed, the cost of imported goods like steel, aluminium, and electronics rose. This shifted the supply curve leftward, decreasing supply, leading to higher prices for consumers and possibly lower quantity demanded. Elasticity of demand and supply. Tariffs affected goods differently depending on how elastic they were. For example, if consumers had inelastic demand for a good like essential tech parts, they continued buying despite high prices. For more elastic goods, demand may have dropped.
Moving on to the macroeconomic concept, China's response to Trump's tariffs serves as a strong real-world example that ties into several major areas of macroeconomics, such as inflation. Retaliatory tariffs raise the cost of certain imported goods and production inputs, contributing to cost-push inflation. As prices for some goods rose domestically, inflationary pressure increased, affecting consumer purchasing power and economic stability.
Economic growth. The trade war created uncertainty and slowed business investment, which put pressure on China's GDP growth. In response, China shifted its focus towards boosting domestic consumption and introduced stimulus measures to support the economy. Lastly, employment and output. Key export driven sectors in China, such as manufacturing and agriculture, were negatively affected by reducing demand from the US. This led to potential job losses and lower production, influencing China's overall employment levels and output.
Now, lastly, moving on to the global trade aspect. The India-UK Free Trade Agreement, or known as the FTA, is a strong modern-day example that illustrates several key aspects of the global trade topic in IB economics.
Such as trade and economic developments. For India, securing better access to UK's market could support development goals by boosting exports, employment, and investment. This links trade policy to broader development strategies.
Moving on to the role of the WTO, or the World Trade Organization, and types of trade strategies. While the WTO promotes multilateralism, this FTA is a bilateral strategy, showing how countries may prefer direct trade deals for faster or more tailored outcomes, which can also undermine or bypass the WTO framework.
Lastly, globalization and trade patterns. The UK's push for this deal reflects post-Brexit efforts to reduce reliance on the EU and diversify global trade links. This ties into the changing geography of global trade and geopolitical influence on the trade relationships.